Before you invest another single dollar into an index fund, you need to hear what Wall Street has been hiding from you. For the last 20 years, every financial guru, every YouTube channel, every Reddit thread has screamed the same thing. Just buy index funds. Set it and forget it. And honestly, that advice has made millions of people pretty average investors. In this video, I'm going to show you 3 reasons why index funds might actually be limiting your wealth. And then I'm going to reveal the one strategy that most financial advisors use for their own money, but rarely tell their clients about. Stay with me because by the end, you're going to see your investment portfolio completely differently. And look, I want to be upfront. I used to be a massive index fund believer. I preached it to everyone until I actually dug into the data. And what I found genuinely shocked me. So let's start with the problem most people don't even know they have. Here's something most people completely ignore: tax drag. Every year, even in years when you didn't sell a single share, your index fund may be distributing capital gains to you. And that means a tax bill. You didn't do anything. You didn't sell anything. But the IRS still shows up. Let me show you actual math. Over 30 years, the difference between a tax-efficient investment and a standard index fund at the same rate of return can be over $50,000 on a $10,000 investment. That's not a small rounding error. That's a year of retirement income just gone. Okay, I'm being a little dramatic. But here's the real point. Most people picking index funds have never once asked, how is this taxed? And that question alone could change everything. But the tax problem is actually the smallest of the 3 issues. Let me show you number 2. But before we get to the alternative, let me introduce problem number 2, because this one is quietly building up in everyone's portfolio right now. And most people have no idea it's happening. Here's the lie that nobody talks about. When you buy an S&P 500 index fund, you think you're diversified across 500 companies. But are you really? As of right now, the top 10 holdings make up roughly 35% of the entire fund. That means more than a third of your money is tied to just 10 companies. Mostly big tech. That's not diversification. That's concentration with extra steps. In every major crash of the last 25 years, the most overweighted sectors dragged the entire index down. And you had no control, no ability to reduce exposure. You just had to hold on and hope. What I'm about to tell you next is why I almost quit investing entirely. And it's the reason I started researching alternatives in the first place. I had been doing everything right, maxing out my index fund contributions, reinvesting dividends, low-cost ratio. By every metric, I was a model investor. But my portfolio wasn't growing the way I expected. And when I finally figured out why, I was furious. Because it was so preventable. Everyone brags about low expense ratios. My Vanguard fund charges 0.03%. Great. But there are costs buried inside every fund that never show up in the expense ratio. Fund turnover creates taxable events. Bid-ask spreads cost you money every time you buy or sell. Market impact costs hit large funds hard. Put them all together, and your almost free fund might be costing you closer to 0.5 to 1% annually. Now, I want to be fair. Index funds are still better than most actively managed mutual funds. Most of them. But better than the worst option isn't the bar we should be aiming for. There is a third option that most people have never even considered. And it's been right under your nose the whole time. Okay, it's time. Let me introduce you to direct indexing, the strategy that wealthy investors have been using for decades, that's finally available to regular people. And it fixes every single problem we just talked about. Direct indexing is simple in concept. Instead of buying a fund that owns stocks, you own the stocks directly, in your own account. Your broker holds Apple for you, and Microsoft, and Amazon, and so on, all the way down. The result? You get all the performance of an index, but you get to customize every single piece of it. Here's where the magic happens: tax loss harvesting. When one of your individual stocks dips below its purchase price, even temporarily, you can sell it, capture that loss on your taxes, and immediately buy a nearly identical stock to maintain your market exposure. A traditional index fund cannot do this for you because you don't own the stocks individually. With direct indexing, you can. And studies show this can add 1 to 2% in after-tax returns every single year. Benefit number 2, you get to exclude anything you want. Don't want tobacco companies? Gone. Don't want fossil fuels? Gone. Don't want to own competitors to your employer's stock? You can remove them. This is genuinely personalized investing, not a mass-produced fund with your name on it. And benefit 3, true diversification. If your compensation is already tied to one company or one sector, technology, finance, healthcare, you can reduce that exact exposure inside your direct index. Try doing that with a vanilla index fund. Direct indexing literally solves all 3 problems: tax drag, eliminated through continuous harvesting; concentration risk, you set your own limits; hidden fees. Increasingly, major brokerages offer direct indexing for free or near free. But there is a catch. And I want to be completely honest with you about it. Here's my honest take: direct indexing is not for everyone. If you have under $10,000 to invest, stick with a low-cost index fund for now. It's still a smart move. If you hate complexity and want to think about your investments as little as possible, a total market index fund is still perfectly solid. And if you're in a tax-advantaged account like a Roth IRA or 401k, the tax benefits of direct indexing matter a lot less. So be strategic. Here's the simple rule: if you have a taxable brokerage account with more than $50,000, direct indexing is very likely a better option for you than a standard index fund. Full stop. If your situation doesn't match that criteria right now, index funds remain a solid choice. Just know that they won't be the best choice forever. The financial industry loves to sell you one-size-fits-all products. Index funds were the revolution. They beat most actively managed funds. That's real. But we're in a new era now, and the tools exist to do even better. Let me show you exactly how to get started. Step 1, pick your platform. The major brokerages, Fidelity, Schwab, Vanguard, have all launched direct indexing products in recent years. There are also newer fintech platforms like Wealthfront, which offers direct indexing starting at $100,000 with automatic tax harvesting. For smaller accounts starting around $10,000, look into Betterment Premium or SoFi's automated options. Do your research on current minimums. These change fast. Step 2 is critical. Know your tax situation. The higher your income, the more tax loss harvesting saves you. If you're in the 22% bracket or above, the after-tax returns from direct indexing can easily outpace any index fund over a decade. Step 3, set your exclusions and tilts up front. This is the part where investing actually becomes yours. And step 4, and I cannot stress this enough, don't throw out everything. Index funds belong in your tax-sheltered accounts, where the tax benefits of direct indexing don't apply. Your Roth IRA? Great place for a total market index fund. Your taxable brokerage account? That's where direct indexing shines. Use both. Be smart about which tool goes in which account. Let's recap what you now know that most investors don't. 1. Index funds have a hidden tax drag that costs tens of thousands over a lifetime. 2. The diversification in most index funds is largely an illusion. You're really concentrated in 10 companies. 3. The fees aren't as low as advertised when you look under the hood, and the solution is direct indexing. Owning the individual stocks yourself, harvesting tax losses continuously, and customizing your exposure to actually match your life. Here's what I want to leave you with. The goal of investing isn't to follow the crowd. It's to build wealth that's efficient, personalized, and built to last. You now know something that most people, even financially savvy people, have never heard of. Use it. And share this video with someone who's still putting every dollar into a plain index fund and wondering why their wealth isn't growing faster. If you got value from this, subscribe. I drop financial breakdowns every week that go way deeper than the mainstream advice. And if you want to keep going, my video on Roth IRA conversion ladders is right over there. It pairs perfectly with everything we just talked about. I'll see you in the next one.